Good morning, good afternoon, everyone. Welcome to this week's Pro9 Insider. Before we get started, I just want to do a quick mic check. Make sure everyone can hear the sound of my voice. Please type a 1 in the questions box if you can hear me loud and clear. All right, excellent, excellent. Looks like I'm coming through. See a few familiar names. Welcome back. For anyone new who's not familiar, my name is Greg. I handle the training here at Pro9 Trader. And our goal with this class is just to make sure everyone is up to speed, has a good grasp on the rules. I also like to look at what type of market conditions to avoid, how to avoid chop. Different things to look out for. Maybe when it's a tougher trading day that can help us avoid some losing trades or further qualify a trade, giving us a little bit more confidence in there. So of course I want everyone to feel free to ask any questions that pop up. This is for you guys. So I feel it's always beneficial to ask questions if you have it. Could help someone else who may not even realize that that's a question they should be asking at some point. They might not be there yet, and that can help kind of jumpstart them and take them up a couple notches. So, all right, and with that, let's go ahead and jump into it. Let me open up my rules real quick. Just so we have them there. All right. Just 1 second here. There we go. All right. So I'm sure you guys may have noticed the markets have been fairly choppy. This has been a common theme the last couple weeks. Not out of the ordinary for this type of year. So during this time, I just like to stress exercising a bit more caution, especially when we have signs of chop, even if it's just a little bit, or if things look like they might start heading into chop. I usually kind of just pump the brakes for a second, wait till we restore, or the market returns to clearer trends. And we'll go over that. As we can see here in the CL, not a lot of action. Couldn't really take this continuation short. Our super trend isn't outside of the neutral zone. If we look down here, let me bring that up a bit. And our turn bar didn't quite touch the 50. That's why we have these yellow bars. They let us know that that rule is not qualified. And then kind of just get a bit of chop here. So Diane with a question on the surf trade. The wick is used. Any other times you might look for wicks? Not really. Not as far as any trade entries go. Most of them we look to enter on the turn bar or first color bar, and that's independent of a wick. The turn bars will always have a wick or tail. But that's mainly for the surf trade, because we do get the surf trades that can happen counter trend. Those are actually some of my favorites. I feel those are the strongest surf trades when everything else lines up. So, and if we're going counter trend, we might not always get a turn bar or a purple bar to enter on. So we look for any bar with a wick. All right, so not much happening in the CL. Let's go ahead and just kind of cruise through the markets. If you guys want to take a look at any particular day or particular trades you may have taken earlier in the week, go ahead, throw those out there. Market and time in Eastern time would be the easiest for us to locate those quickly and kind of analyze those. So let's kind of walk through. Markets open at 9:30, of course. We have the EMD here. Not too many, or not any entries yet. Do have like a small continuation here, or a single T, sorry, that we can grab. The 200 is not in order. I generally like the single T's with the 200 in order. Those are a bit stronger when everything lines up. But bouncing off the 50 is a pretty strong signal, which is why we use that as a line. We can say, if we bounce off the 50, we can go ahead and ignore the fact that the 200 is maybe not in the correct order. But I also do get a bit nervous trading in this range here with the 200 in between the 50. But it's not terrible in this case because we have a decent long trend here. Usually when these EMAs get ropes together, that's when it gets really dangerous. I still am pretty cautious. I definitely wouldn't trade and take any trades into the high of the day because we'd be trading into the 200. Even if we could. One thing I do like to point out, we really like to see this blue line coming from extremes pretty consistently. So we come from an extreme here on the way up, hit an extreme, come back down, and then this bounce off the zero line. I really, really like that. So if we kind of land right on the zero line, and then bounce back up, and we're looking to take a single tier continuation. That's a fairly strong sign, so that might give us a little extra confidence to take a single tier continuation. Kind of the same story on this one, another single T entry. We can ignore the 200. Coming from an extreme with the blue line is also a very strong sign. So bounce off the zero, get a quick profit target here. Then we almost come to our extreme, kind of bounce right off there. This comes back down past our extreme, which is where we want to see the blue line. Very strong indicator. And if we see our single T setting up here, note we just came from an extreme. And then bam, when it cuts through, might have had to do a retracement on this one. Most likely, because if we look back, and I'm sure you guys will hear me harp on this quite a bit, but with the blue line, if we're looking to get it on the first color bar, well, I'm not sure that this is going to cross. It's pretty far. It may, but I don't know that ahead of time. So I use the rule when I'm not sure, wait. It's much better to get in an much better to wait and attempt a retracement rather than try to jump the gun and get into an unqualified trade situation. While that may work out here and there, eventually it's going to come back to bite us. We're going to get in an unqualified trade situation that way, and it's not going to work out. So rarely, I've even had it happen where the blue line is very close, and I'm extremely confident that the blue line is going to cross. I've seen it happen tons of times, and it is very close, and then it just doesn't quite make it. I've had that happen quite a bit, but that's fairly rare. So usually when it's very close, and it really comes with chart time. There's no formula that gives us a definitive way to know where the blue line is going to be after it closes. Some people like the blue line set to calculate on bar close equals false. This way you can see it update live as the price fluctuates. I don't really like that. And in fact, when I was first introduced to Pro9 Trader a few years ago, before it was finalized and released, that was the default setting for the blue line, so we could see it wiggle around, and it kind of gave us an idea of where the blue line may end up. But I found doing that, it doesn't always give an accurate picture of where it's actually going to plot, and I would get quite a few false positives anyway, so I found myself waiting till the bar closed anyway. So just a little food for thought. I know some people like some of their indicators to update live. It can be a bit helpful in situations like this where the 10 and 20 EMA are right on top of each other, and you want to see where if those might spread out enough to qualify on or give us in the correct order for the EMAs on this first color bar. But that's really up to your discretion. I personally like the indicators static and would rather just wait and attempt a retracement. And then so we have this single T here, would likely, let's see, because we can't start trailing at the low of the previous bar here, this would likely stop out our runner. And then we have this momentum trade, but again heading right into the high and the 200. So that's very unsafe because we're just not going to trade into the 200 anyway. Universal rule, it's too risky. You never know when you're going to bounce off or you're just going to take or push on through. And I just don't like to take that chance. If I have enough space before I hit the 200 to hit my profit target, I might, but I'm still pretty cautious around the 200. So you could enter this continuation here, as we do have plenty of space before we get to the high or the 200. I'd probably skip out on those just because I'm very wary of the 200 and the high of the day. You get that kind of double resistance right there. And bouncing off the 200, the resistance isn't always right on the 200. It can be a little before, it can be a little after, one or two ticks past. And especially once the indicators, or once the EMAs get in this range here, is where you'll usually see the price bars get wrapped around these EMAs and just kind of go back and forth. And then there were a couple good examples from yesterday. Let's see. I was in the NQ, I believe, for a while. Well, actually, let's take a look at that. So, yeah, so in this period here, we kind of go in this range, and I'm sure some of you have heard me harp on this before as well, but I think it's very important. The 200 and our EMAs here kind of form a stranglehold. I always get nervous in this situation and just totally put on the brakes. I don't want to enter any trades while I'm in this range, especially when these EMAs are roped together. If the 200 is pretty far, I don't pay that much attention. It's not as worrisome, but it is in this case where my EMAs are just roped together and you see the price bars just wrap around, bounce up and down. And it's almost like a whirlpool that just, sucks these price bars back and forth, back and forth. So once this happens, just very risky territory to trade. I avoid it like the plague. It's not worth it to me to enter those trades, especially when I see these runs aren't going very long. 4 bars here, 6 bars. I might be able to grab a profit target, but I'm not going to get any runners. So it's not worth the risk to try to grab a quick profit target. I really want to try to wait for a clear trend and try to hop into a trade that will result in me catching a runner. So there are always going to be those. Especially lately, there aren't a ton. A few days here and there have produced some good runs. These surfs, like this counter, that's pre-market, but I mean some decent runs this week, but kind of we really have to pay attention to the chop and be a bit more cautious. Um, so here in the NQ, this will be this morning. Right here, a great example of 200 bounce, why we don't ever trade. Um, and then here we move on through it. Well, we kind of bounce off here and then get a little short. So we're still kind of wrapped in here. It's just a long, our support is a little lower than the 200. So starts off pretty decent in the NQ. We had a good momentum here. This first one would have just grabbed a profit target, probably an extra tick or two, it seems like. Then we have another one, and then a third one. So momentums are, especially when the markets are like this, I find them to be a bit more risky than the rest of the trade setups, and not necessarily the first one, but after the first one, and depending how the market's been moving, I do get a little more skeptical and may pass on the second or third. I definitely stop after 2. I just feel once we're heading into the third momentum trade, we're usually pretty far along into the trend, and we're kind of chasing the move at that point. So I know quite a few members have different ground rules they have for the momentum, and I think ultimately we have to leave it up to our discretion, because there are very well times where we have really long runs and you can have 4 or 5 good momentum opportunities on that run. So there's no surefire, don't ever take a third momentum. Unfortunately, there's no way to know when the end of a trend is coming. I wish there were. We've been trying to rack our brains. One thing I do like to look out for, especially if there's been multiple momentums in a run, is my blue line. And with the divergence that starts happening in the blue line. I mean, this move's pretty good. Again, we get the blue line coming from the extreme. Crossover, pretty good. Just momentum overall. EMA is nice and fanned out. And then as we get up here, the blue line starts to show a little divergence. And we get out of that extreme level. And we just pierce the high of the day. So first run in the morning happened within a couple minutes. And this is maybe something that's more particular to this period in the markets where things kind of slow down a bit. But I mean, if you noticed, you've been watching the markets in the morning, like yesterday, first hour and a half, I mean, the markets were moving very quickly. There were tons of trades firing um, across multiple markets, and it was pretty hard to catch all of them. Um, but something I've noticed is that usually after if there's at the open, if there's like a short run up, and we just push through the high, go through a couple bars. Um, I have noticed in a few of these markets that after that we kind of meet some resistance at the high. So I'm a little more reluctant to take um, trades into the high after we've already pierced it uh, soon after the opening. Um, and this kind of goes into just paying attention to the markets and keeping an eye out for um, patterns like that, basically. When you notice things that kind of happen pretty regularly over a period of time, and it could be, a month, 2 months, um, a few, well, longer periods of time, of course, but I always go back to the example, and it was mid last year, maybe around the same time when the markets kind of slowed down, but the breakouts just really stopped working on the NQ for a while. It was really reluctant to push through the high of the day, and it was happening very consistently. So once that happens, we kind of would hold back on the breakouts and just be a little more skeptical. And I even had one member who's a very good trader, and he developed a rule where if he entered a breakout on the NQ and it did not hit his profit target within 30 seconds, he would just flatten the trade. Because he found if it didn't push through, that's what, he did a little bit of back testing, and he found that, if it didn't push through within 30 seconds, it seemed like it was just going to go against you. So, and that was his rule, and it worked out well for him for a period. But, I mean, there are going to be times where you'll notice patterns that may happen over the course of a month or two, and you just kind of want to keep your eyes open. And if you do notice something, if you do notice something, or if you see a setup that may look uh, like a good pattern or something that you think can add strength, I know, tons of traders do this often. They use Pro9, and they use some of their own indicators. They tack on some indicators that they like. I've talked to many traders who do that, um, which is great. I mean, I think as a lot of traders will try to pick out new patterns. Um, and if you do that, just do a bit of back testing. Um, or if you notice something that you think is happening consistently in the markets that can help you avoid some questionable trades, just go back and check a couple months. Um, it doesn't take, you don't have to do it all in one sitting. And it doesn't take a ton of time to kind of scroll back and just investigate a day if you're looking for a specific thing. But you want to find a good amount of examples. You want to get a good sample size so you can make a pretty, well, a more accurate assessment. Of course, more back testing you can do, you can get a better idea, but you don't want to get to the point where you're spending all your time back testing and not trading. So, but it is a good idea. Like I know Scott Dahlquist, who hosts Pro9 Live, does a lot of back testing, and he's always looking for new things that can help further qualify or disqualify some of the trades he takes. So it is a good skill to develop, and it's not a bad idea just to go back and just investigate things. All right. Yeah, not a ton in the NQ. Did have this breakout, perhaps. Yeah, this was like a nice little counter trend surf. So this was back to Diane's question earlier, how we look for the wick. And I do suggest everyone familiarize yourself with the surf. I love it. I think it's a great setup. Now there is some overlap with the momentum trade. So, and most momentums can also qualify as a surf. So I very specifically like these counter trend ones. They give us good opportunities to get in on these runs after a market reversal. This time of the year, it doesn't seem like we're getting very long runs, which is fine. I mean, we can still grab a profit target and a couple extra ticks here and there on moves that we would normally not get into. With the counter trend surf, for anyone who's not familiar, and don't worry if you don't pick it up right away or if you miss a few. It is kind of an odd trade, especially these counter trend ones compared to what we normally look for with our single tier continuation. Most of the trades we're looking to enter in an established trend. So it did take me a while to pick it up to where I'm pretty good at anticipating these. And one of the things I look for, because there's only a couple rules. We need our blue line to get outside of the neutral zone and be below the purple line for the short example. So basically the blue line needs to be outside of the neutral zone in the direction of the trade we're taking. So we're looking for a short. So it needs to be outside of the neutral zone in the negative direction and below the purple line, vice versa for a long trade. And the super trend, and I think this is one of the things that kind of mixes people up a bit. The super trend just needs to be outside of the neutral zone. Doesn't matter which direction. It does not have to confirm with the direction we're going, just as long as it is not inside that neutral zone. So anticipating these, when I see my super trend get up pretty high, and then I get a reversal, but I don't get a qualified divergence reversal. All right, the market starts to reverse, it's not fully qualified. Then I start anticipating it, and once I see my blue line get outside of this neutral zone, and my super trend is still outside of its neutral zone, I know that I can look to enter a surf trade. All I need to see is a wick. And I can just anticipate that until the point where my super trend dips back in the neutral zone. But it's this pretty nice pattern we'll see where the super trend gets pretty bloated, and then on its way down, we catch an entry here, hop in, and then the super trend continues on down to the other side. So, but very strong. I really like this trade. There may be times where it's a bit close to the 50 EMA or even the 20. And typically we don't like to trade into any EMAs. I mean, we say that the 200 is the big one, of course. Um, 50 is uh, one to watch out for as well. Um, I'm I personally am a little more lax with taking a counter trend surf into the 50, um, as I feel more often than not I've seen that it at least hits profit target, even if that is uh, on top of the 50 or a little past the 50. Uh, and that's me personally. I'm willing to be a little more risky. We use the same money management strategy for the momentum trade. So it is a 15 tick stop. Um, I don't find that there's a lot of multiple wicks in a row with the counter trend surf. Once in a while, but it's a little more uncommon than with something like the momentum trades, where sometimes when the market's choppy, you get a lot of wicks in a row. So do like to point that one out for you guys. It's a pretty strong trade setup. So, and especially during this time, it's a good one to watch where there isn't a lot of really strong trends. You know, the market kind of goes through these cycles where it's just up for a while, down for a while, um, but not long enough to really establish a very strong trend. So, just gives us additional opportunities. Then we have this momentum here, which may have been stopped out. Let's see, we have our entry at 5807.25, and the high of this bar is 5809. So that may have hit profit target, may have been a scratch. It did go 7 ticks, so it traded through our target price. Um, when the market is moving pretty quickly, if it like it has been this week, I've had quite a few orders just blown right past. You know, as soon as I get a trade set up, I put my order in, and then the market just moves so quickly it just jumps over my entry. I don't get in. So we want to have a plan for what to do when that happens. Now, if it jumps over, sometimes what'll happen is you'll have your order jumped over, and then you get a quick retrace. You know, it jumps over a couple ticks, retraces back to your entry, and then you'll get filled. Um, that's fine with me because it's, you know, same difference. You still haven't gotten to the point where you would have hit profit target. So we're still waiting for the market to do what we expect it to do according to our indicators. In the event that the market jumps over our order and gets to the point where it hit our profit target, even though we weren't in there, we know what our profit target is. It's, you know, 6 or 8 ticks from our entry, whatever. Once it gets to that point, you want to be prepared to cancel your order because the market has already done what we expected it to do. We just weren't able to get in. We don't want to leave a long order in, you know, and have it jumped over, market hits where a profit target would have been, and then we get a really fast reversal, which can happen. The market can whipsaw sometimes, and you don't want it to fill your long order on the way down. You're probably likely to get it stopped out very quickly. So sometimes, and when you see that happening frequently, you know, you just want to be prepared to cancel your order. Also, with the ATMs, if some of you are using the ATMs, makes trading so much easier. But I do suggest with each of the stop strategies, you can set an auto break even. Just set it to your profit target on each of the targets. And this has been happening more frequently as well since the market's kind of, when there's a move, it tends to move very quickly. But the market will race up, you get filled, races up to your profit target, kisses it very quickly, doesn't have enough time to get filled, but that will trigger your break-even stop. And then if the market retraces back to your entry price, you get stopped out at break-even. It was a scratch. Didn't lose anything. May catch a tick or two if there's a bit of slippage. But the point is we want to avoid the case where, if that didn't happen and the market jumped up, hit our profit target real quick, and then could still reverse even though our profit target was hit, but we just didn't get filled there. So I like to avoid that situation altogether. I'd rather take a scratch than a loss on what would have been a winning trade, because some things we just can't control in the markets. So very good idea to do that. Or if you're trading manually, be prepared to move your stop to break even once the profit target is hit, regardless of whether or not we get filled. And this can kind of tie into slippage as well, which I haven't experienced too much since we use limit orders. It is still certainly possible on some markets, especially a market like the EMD where it has quite a bit lower volume than something like the NQ or CL. You may have your entry target or your entry price at whatever it is, and you get in a tick or two late. Slippage going to happen. We can't really control that. So if that's the case, we want to adjust our profit target. So if basically you want to leave your profit target where it would have been if you had entered at your designated entry price. So so one second here. So in the case of the EMD, if my entry price on this momentum, my entry price is 1709.6. So I know my profit target is going to be 1710.2, right? 6-tick profit target on my momentum. So I put in my order and I get filled at 1709.8. Well, I'm still going to leave my profit target at 1710.2 because that's where it was from my entry. The only thing that changed is that I didn't get filled at the exact price I wanted. I don't want to adjust my price and say, oh, well, I got filled late. I should just go for my normal profit target. We don't want to do that because we have our profit target a certain number of ticks because that's what we've seen happen consistently. So adjusting it just because we got filled at a worse price decreases our odds of hitting our profit target. It would be similar to chasing a trade or saying oh well, this just happened, I can get in on a retracement or I can get in on the third bar after a qualified trade. We're chasing the trade at that point, and eventually it's just going to come back and bite us. So it's much better to be safe and a little cautious and stick to what we know, because saying we enter at this price looking for a profit target, this is what we expect the market to do roughly 80% of the time. So if we start changing that around, we're going to start getting inconsistent results and perhaps taking a few unnecessary stops where one or two extra ticks could be the difference between getting stopped out or hitting your profit target. And I'd much rather collect a 4-tick profit target than no profit target at all if I got a bit of slippage. And then finally in the end, Q does catch a really nice runner here. Um, can hop in here. We're heading into the high of the day. If you want to be a little more cautious, uh, I will do this sometimes where instead of, if my entry is very close to the high, I'll just wait for it and enter it as a breakout. So I want to make sure we get back or past the high. And we don't bounce right off of that, especially if you've had this little kind of stair step up. Um, but even in that case, you may be a little more cautious because we've probably haven't gone 8 ticks once we break out of the high here. So uh, that's something I like to do. You may not like it as much. I mean, on one hand, if you're going to enter it as a breakout, might as well try to get in at a better entry price. Trust our purple line outside of the neutral zone. We did have a nice bounce right off the zero line. Can give us some extra confidence that we'll at least hit profit target. So I find if my trade is qualified and I find a little extra confirmation in my indicators that can give me just that little bit of extra confidence, we'll go ahead and enter the trade. So give me 1 second here. All right, just had to grab a quick drink here. Another thing I want to focus on too is the mental and emotional aspect of trading. I do touch on it once in a while. I do like to spend a little more time on it, especially if you're just starting to go live. You've been doing well on sim and are decided to go live. There is a huge difference. So we can, simulated trading is great. You do get some of that emotions, especially if you're treating it seriously. But there's just something different that happens once we know we have actual money on the line. With a simulated trade, if it goes against us, yeah, we're gonna might get a little frustrated and say, oh, I should have done this or shouldn't enter that trade. I knew I shouldn't have done this. But that will be magnified with once you get into live money, because I think, and I'm prone to do this myself, is that if I'm sim trading, maybe testing out a new setup or something like that, and it goes against me, I find that I can rationalize that it's not as big of a deal with the sim account. So you can kind of lessen that and may not be fully prepared for taking a loss with live money. So something to understand, this is trading. We are going to take losses. Some days are certainly going to be rougher than others if we're not always paying attention to market conditions or paying attention to signs of chop and that type of thing. But the great thing is we can train ourselves to deal with that, and it's something that just takes persistence and time. It's kind of something that you have to train yourself to realize is we're not, if you things I kind of find are pitfalls is the woulda, coulda, shoulda type thinking. Um, if you decide to pass on a trade because it was too risky, or it's something in the indicators, it looks kind of choppy, you're not too sure, so you decide to pass. And that one happens to be the one that is the big move out of chop. So we aren't always going to be able to know when that is or have good indications. So then we get in that, oh, I should have taken this trade. You get in that kind of thinking. And I really find that's just counterproductive to trading, because then you can start kind of tricking yourself into disregarding certain things the next time that situation happens. And the next time that situation happens, and it was a bit choppy and you're not sure if it's out of chop, and then we enter that trade, it could be an almost identical situation, and that one goes against us, then we're right back into it. Oh, I shouldn't have taken this trade, and it creates a bunch of turmoil. It affects your judgment, because now, we don't know which way is up. We've seen identical situations. One time it worked out, another time it didn't, and it can affect our judgment, our confidence with pulling the trigger, and we don't want that. So we just have to understand we are going to take losses occasionally. And some days that may be less than occasional. I did have a rough day myself yesterday. But I don't let it totally get me down or affect my judgment. The markets aren't going anywhere. There's going to be more trades. I just have to remember to be cautious, watch for signs of chop, trust my indicators. If I make the decision to pass on a trade, I've made that decision. Once that trade is done, whether it would have succeeded or would have went against me, that is completely irrelevant to me after that point. I've already made my decision. I don't like the idea of, that wishful thinking of, oh, that was a great runner. If only I'd entered that trade. I just, put that on the shelf and just focus on the next qualified trade setup. Pay attention to the indicators. If I decided to pass on a trade, there was probably a good reason for it, and it really just boils down to, I found a situation too risky for me, and this can vary between traders, whatever your, risk tolerance is. Some traders are a little more aggressive, some aren't. I'm, fairly middle of the road, lean a bit more cautious. And there's a lot of factors, whatever your account size, your daily profit target, what your overall goals are, maybe for a week or a month period, that type of thing. But the overall point is, once we make a decision in trading, that's really it. That's, just full stop. Because if we start getting wishy-washy with our decisions, then we're just going to put ourselves in throw ourselves for a loop and get into all kinds of trouble. I am of the philosophy I like to make as few decisions as possible when trading. So it's either, is this a qualified trade? Is the market choppy right now? Is there really any reasons why I shouldn't enter this trade? If not, then I'll take the trade, and that's it. Or, I won't take the trade. And then whatever the outcome, I made that decision. I can't remake it. I can't change it. So I just have to be resolved with the outcome, and just know that over time, our win ratio is such that it'll work out even if we take losses. I always, Waz, who used to do the training, would say that those are within tolerances, or those are, we do expect some losses to happen. But our money management strategy is designed to directly counteract that with our initial profit target, and then the runner, which is where we make the bulk of our profit. So something else that relates to the kind of mental pitfalls we can fall into, and this will go back to earlier I was talking about doing back testing. If you notice something, you want to make sure you want to get a good amount of data, we can make a more accurate judgment, is because, and all humans do this, it's pretty natural, confirmation bias. We can train ourselves to recognize it and remind ourselves, hey, maybe I need a little more information. But it's basically where we look for information or data that confirms something we already think is true or already believe to be true. So how that relates to trading is, if we notice something, and I say, and I heard this one a lot, so I like to use this as an example, as I've heard people say, when I see this dot and the blue line get to the crossover, that's a trade. It wins. And there was someone who said it won 100% of the time. And I can guarantee it may be higher than that. I'm not sure. We have, very specific rules for our divergence reversal. But I guarantee you it's not 100% of the time. And that was their only rule. Just dot, blue line crossover. And while it may be a good trade most of the time, I haven't got around to back testing it yet. I would like to. But what can happen is we're only looking at the times that this wins, and only in certain markets. Maybe it wins more often in certain markets than others. That could certainly be the case. But, maybe I'm only noticing when it wins, and my brain just kind of filters out those times where the same situation happens and it doesn't win. And that's basically what confirmation bias is. It's almost automatic, or a habit that we kind of get into. So we just have to remind ourselves, well, instead of saying, oh, well, this always happens, I kind of approach it from the viewpoint of, oh, well, that's interesting. Let me find out how often that happens. And that's why I always stress, if you notice something new, or you think you spotted a pattern or some, back test. And that could be as simple as scrolling back. You don't have to do it all in one day, like I said before, but just scrolling back, looking for that pattern, maybe slight variations, and see if it actually works consistently over a good period of time. But the more information you have regarding that, the better judgment we can make about whether that pattern is successful, or if it's, could be an additional rule that helps us disqualify trades or confirm, further confirm some of our trade setups. All right, well, that hour flew by pretty quick. We're down to the last 5 minutes. I thought we had a bit more time. So if you guys have any last minute questions, feel free to throw those out there. Do want to make sure everyone is up to speed, make sure there's no lingering questions or confusion. But a lot of it's common sense, and a lot of it's just experience that you get with screen time. So the more time you can spend sim trading, or if you're already to the point where you're trading live, it's really just about chart time. That is the most important thing that's going to get you up to speed as well. Just follow the rules to a T. Stay diligent. Don't get spooked by losing trades. They are going to happen. and sometimes they can be, frustrating, especially when the trade looks really good and it just turns out to be a head fake. Those happen. Um, Sometimes they're just unavoidable. Qualified trades do go against us, um, but we don't want to get in the situation where we take a trade that goes against us and then stop trading for a while. You can kind of go on tilt where you're frustrated, or start doubting the setups, and then more often than not, the next trade is probably going to be a winning one. I've seen it happen time and time again. Uh, so uh, Something to keep in mind. Mainly it's just diligence. Also, things that help us or help me get around that is trying to kind of zoom out and look at it in the long term. I don't really like to look at P&L trade by trade. Uh, Moreover, just the end of the day or end of the week, and have kind of a weekly goal or even a daily. I mean, a question from Mary: if the 50 EMA touches 2 or 3 times, is that good or bad? You mean like the if a bar touches the 50? Um, I guess it kind of depends, but like for a single T, some of those single T examples we saw earlier, um, you might see the price as the bar's building, you might see it fluctuate, and it might come down and bounce off a couple times, but ultimately I look at it as it's just bouncing off. So as the price fluctuates, it could do that 10 or 20 times. I don't know that makes it stronger or weaker. I haven't actually looked at if how many times it bounces really affects. I just look at it as one bounce, because all I care about is, did the price come down and touch the 50 and continue to move in my direction? And that would be kind of a bounce where it just bounces once. Well, not once, but it did bounce. And that just means we're getting a good amount of support or resistance at that point where the price isn't going to move through. So um, the sellers kind of get rejected by that. There's just a line in the sand there that it's not going past. So I don't really think how many times the price touches the 50. I don't think it's that relevant, but I'm just not sure. So, but when I look at the charts, when we look historically, we can't see how many unless you're doing like market replay, which takes a considerable amount of time, more amount of time, especially for long periods. So, which is why sometimes we may have to do that if we want to know specific things. But when I'm looking back historically, I don't really think about how many times it would have bounced, just that it did. So, all right, everyone, we are down to the wire. Um, Thank you for joining me. I hope you guys were able to learn a little more than you walked in with. Like always, if you guys have any feedback, stuff you'd want to see more, does the class need to focus more on the rules, or do you think the kind of area of discussion is more beneficial to trading? I kind of like to gear it how it is, as I find the rules are readily available, and that's more pattern recognition, but there's a lot of other little details that can kind of help advance us a bit quicker outside of the rules, because we can all refer to the rules and learn to recognize the patterns. So, but if you guys have any feedback, some other stuff you want to hear in the room, you think there might be a little gap of stuff you want to see covered, feel free to throw us a email that support. We do want to make this class as good as it can be for you guys and as educational as it can be. So again, thank you for joining me. I hope the rest of the trading day treats you well. Everyone have a wonderful weekend, and until next time, happy trading.